All right, what's up, BiggerPockets? We are back. Sorry about the technical difficulties. I want to give a shout out to Tony for hanging in there with smiley faces and being understanding. So, if you guys can re-smash the like button, that we're back in action. Hopefully, it'll will stay that way for now. And let's see. So that was we ended on the worst deal, and someone pointed out that the deal was so bad that's why BiggerPockets cut our stream. I don't think that was the case, but maybe. I will say, but again, getting back to our first rule: no investors lost money. Always be willing to change your plan if necessary to keep that in mind. Don't lose money, especially when you're syndicated. Curtis had a question, and he was asking, "Hey, if someone has heavy liquidity, how do you approach somebody to not only just invest with them, but also to learn?" And that's a really good way to get into the business and learn the business. So there's a couple of ways. It depends on how much liquidity you actually have and how much liquidity the person you're approaching needs, right? So if you've got a million, I'd call that heavy liquidity, and you find someone who's doing deals that require anywhere from 500,000 to $1 million in equity, you can go to that person and say, "Hey, look, you don't need to syndicate. Let's just partner. Or let's just JV on this, and do a little research before you partner, right? Because it's kind of like marriage. It's easy to get into, really tough to get out of. So be careful of just hopping in and making partnerships, but picking the right one can be fantastic. But back to liquidity. So if you find someone who you can supply all of their liquidity, that is definitely a big win for both you and for them. You can be, as long as you guys agree in advance on what the roles are going to be and who's what, and you're approaching someone who's raising millions, then you are probably going to be able to invest as an LP and just have a conversation with that person up front. Say, "Hey, how can I learn more about what you're doing than just the average person who's putting in 100 and it's, 1 out of 20 investments?" And just have that open conversation with them. Maybe it's property visits every month, and report back on, is it clean, is management taking care of things, were did the manager greet you, nicely, were there residents just loitering around doing things they weren't supposed to. See if there's a way that you can get involved and add value, but also be careful not to detract from what your partner is trying to do, right? So you don't want to be calling 3 times a day about this. "Hey, what?" Or mentee arrangement, and you adding value as much as you can, even beyond just the capital contribution. Let's see. All right, so we have a question here. What property management software would you recommend for an investor with 10 plus properties? I'm not sure if we're talking single family or maybe small multifamily. There's a handful out there. Rent Manager seems to work pretty well. I have not used Appfolio, but I've heard good things about it. We actually use Yardi, which is probably a bit too expensive and beefy for what you're asking about. And actually, that's kind of all that my direct experiences with Rent Manager and Yardi. But again, I can hear a lot of good things about Appfolio, so maybe check that out. And okay, wait, you're not seeing the video?
Hmm? Oh, now we're back. Now we're back on YouTube. Yeah, first couple minutes we did not.
Oh, okay, sorry about that. I heard that no one could see the video. So, all right, so it might be time to upgrade to a laptop. Apparently, if a laptop's 12 months old, then that's way out of date. All right, so let's see. We have another question: how to invest in syndications? And guys, remember, if this is at all helpful, or if you're liking any of these conversations and like to see me back, please hit that like button so that everybody knows. Let's see. So, how to invest in syndications? Well, the first thing is find a good sponsor that you are comfortable placing your money in. The deals are great, and you'll see, there's deals coming across all the time from all over the place. And candidly, someone who knows how to work a spreadsheet, make the numbers come out to pretty much anything they want, whether that's intentional or they're just making bad assumptions. At the end of the day, what it comes down to is you're investing in a deal, but you're really investing in the person who's putting that deal together, right? You're investing in the syndicator, not necessarily the syndication. And so what you want to do is you want to let's say you've got a deal from a sponsor or a syndicator. Number one, talk with them live. Get on the phone, talk with them, kind of get a gut feel of who they are and if you connect well with them and if you feel like you trust them. Ask for their track record, some other deals that they've done. Ask the question that one of you guys asked a little while ago. Hey, what's the worst deal that you've ever done? See what the answer is. If the answer is, oh, I've never had a deal go bad, that's not good. And it's not good for two reasons. Number one, they might not be being honest with you, but two, success is actually a bad teacher. You learn the most from the mistakes. And someone who's only had a handful of deals and they've all gone great, that success can create blind spots and it can create overconfidence, right? So that's a great question, is what's the worst deal you've ever had? Ask for references and actually call them. That's something like a question I get a lot is, hey, can I talk with some of your other investors? And if the sponsor or the syndicator has happy investors, then at least some of them should be more than willing to talk with you. So those are some of the good ways to invest in syndications. Tony and Patrick, they just thank you for coming back. Dude, you guys are awesome. Thanks for waiting that whole time while we got this stuff sorted out. Appreciate it. See, what are the downsides of syndication? Well, if you're looking to become a syndicator, one of the biggest downsides is the additional responsibility that comes with having other people's money, and that generally speaking, if someone's putting $50,000 or $100,000 or whatever it is in your syndication, that's money they've worked hard to earn, and now it's your responsibility. And you may have 10 or 15 people or 20 or more in your syndication, and they're trusting you. They're relying completely on you, and even when deals go great. And that's actually one of the upsides is it's so nice to be able to, hey guys, guess what, we did really well, here's a lot more than we said you're going to get. That's great. But there's always the knowledge in the back of your mind that having other people's money is a greater responsibility than your own. From an investor standpoint, one of the potential downsides might be you're not, if you're looking to build truly just get your hands dirty and really get in there and learn the business. It can be a little bit harder to do that if you're placing money with somebody else and they're running everything. The other potential downside with syndication is if you pick the wrong sponsor, if you don't go through that vetting process that we just kind of talked about a few minutes ago, you pick the wrong sponsor, you're kind of stuck. And the other potential downside, not necessarily to syndications, but just to kind of apartments in general, is it's not a super liquid thing. If you're looking to have your money back in 6 months, this is probably not the right investment vehicle. It's generally a 3, 5, 7, 10 year or even longer type investment. All right. Let's see, we've got Anthony, raising money, finding deals. What does life look like for someone who specializes in each of these? Are they compensated differently? What kind of skills does each role need to be successful? All right, well, that's a whole separate webinar. Generally speaking, if you're, there's a lot of commonalities. So in order to raise a lot of money, find a lot of deals, the biggest thing on both of those comes down to networking, right? So if you're looking to find a lot of deals, you're going to be networking with brokers, maybe even with property owners themselves. If you're looking to raise money, you're going to be trying to network. You're going to be going to places where other investors are going to be hanging out, right? So you might be going to Chamber of Commerce. You're definitely going to be going to as many real estate meetups as you can. BiggerPockets has got a lot of good ones. So if you're just starting out, I would say start there. Start with the BiggerPockets community, definitely for raising money and just kind of growing your network. Also, just industry events. Bigger Pockets conference that just happened in Nashville. I guarantee, out of 1,000 people, there was probably 999 investors there, right? And then one guy who accidentally walked into the wrong building. If you're looking for deals, go to actually both deals and investors. Go to industry conferences such as IMN puts on conferences in various cities across the country. If you go to some of the other I don't want to say gurus, but teachers out there. They do various conferences. You can go to those conferences and network with people to find other investors. Just your dentist, your doctor, just anyone that you come across day to day. That if you're looking to raise money, you are a networker. You are out putting the word out what you're doing. As far as compensation goes, that's where it can get just a little bit tricky. If you're out finding deals, that's the easiest. And if you find a deal and bring it to either do it yourself or bring it to somebody, you can do acquisition fees, and where they just pay you whatever let's say the acquisition fee is $100,000. Maybe they pay you 10,000 or 20,000 or 50,000 or whatever it's going to be. Maybe 50 is if you're going to be an even partner on it. That's one way. There's equity in the deal. There's, especially if you're going to stay and be a part of it. You can get cash flow. There's actually a lot of different ways. If you're a money raiser, the SEC very, very clearly states you are not allowed to be compensated based on raising money. And that's probably one of the biggest mistakes that I see people making these days. Is it's like, hey, I can raise 500, I can raise $500,000, and let's partner and we'll split up, based on how much everybody raises. That is illegal. The SEC takes it extremely seriously. You will end up with a big fine and possibly in white collar prison. And if you're wondering what that's like, there's a great scene in the movie Office Space. I recommend go watching that. Do not ever ask to be compensated for raising money. Now, what you can do is you can partner and become a general partner and agree in advance, I'm going to get X% of this deal regardless of how much money you raise, and then go out and raise as much as you can. It is a bit of a risk for the sponsor or the syndicator to do it that way as far as whether or not you as the money raiser perform, but that is the way to do it legally and to not get yourself into trouble. So if you're doing any of this stuff, definitely reach out to a syndication attorney before you actually start moving forward. At least have a conversation. Most of them, like I use Gene Trowbridge. If you reach out to him and say, hey, I'm about to do a deal, I believe he'll at least talk on the phone for a few minutes and kind of get you lined up so that you don't do something illegal. And obviously hoping that you'll become a paying client when you start doing your deals. All right, Lloyd. Hey, good call, Lloyd. Says, come on, everyone, let's give Andrew some thumbs up. Thumbs up to you, Lloyd. Appreciate it. Please, everyone, follow Lloyd's advice. I like that. Good job. All right. What are let's see, we have, Manny. How to find a good, fair, and reasonable property management company for 5 out-of-state units. Very, very important question, and because truly one of the biggest keys to the success of your multifamily investments is going to be your property management. And it varies depending on the size of your deals, right? And candidly, in my experience, the smaller the property, the tougher it is to find good quality property management. That's one of the benefits of scaling up over, as you grow, the property management piece gets easier. For a 5-unit property, the number one thing, if you're talking to brokers who are sourcing or bringing you the deals, or if you know brokers in the area, I would start off and call all the brokers and say, hey, who can you give me what are the top 2 property management people or companies that come to mind if you were going to have someone manage this property, right? And you get a list of referrals. Then you try to find again, this is another great thing you could use BiggerPockets for. Get on BiggerPockets and say, hey, I have some 5-unit properties in Dallas. Who else out there has similar properties, and do you have any property management recommendations, right? So That's really what you want to do, is go through and think of those two plus any other avenues you can come up with to build a list of referrals. Go to real estate group meetups again and find investors and say, hey, how are you doing property management? So build a list of referrals, and then hopefully you'll get a pretty good list, maybe 5, 6, 7, 8 companies or people. And then you're going to want to do a little bit of internet research on them, right? Find out, look at their websites, find out how long they've been in business. Go look at go look for listings that they have for rentals. Look at the quality of the listings they're putting up. And then for the properties that they're managing, see if there's reviews online and see what people are saying in their reviews about the management company. And keep in mind, most people, when it comes to online reviews, most people are typically the only ones doing reviews are the grumpy ones. So take it with a little bit of grain of salt, but that's definitely something I would do. And then narrow it down to a list of maybe 2 or 3. Interview those on the phone, and then I would take your top 2 and do an in-person interview with them. So that's what I did. That's how we found our property management company in the Southeast. We've been using them for 8 years now. That's exactly what we did. We talked with brokers. We got a list of referrals. We did research. That eliminated a few. We got it down to a small list. I interviewed them on the phone, and then I flew out to Atlanta, sat down, had dinner with the owners of the companies, which is basically an hour and a half long interview. And they're interviewing me too, and they're going to interview you because it's a partnership. And we picked one, and it worked. We have a great property management company. We've been using them since the beginning, and we're very happy with them. So that's what I would do to find good property management for 5 out-of-state units. All right. William, I am currently deployed. How would you go about real estate investing from such a far distance? Everyone give some thumbs up and likes to William. Thank you for your service. I can't imagine doing what you're doing. Then thank you so much for doing that. As far as real estate investing from a distance, it's in a sense it's not too different than being in, say, California and investing in Georgia. The key for you is really going to be finding trusted partners. And again, it kind of depends on your goals, right? So if you're just looking to put chunks of money into real estate and have passive income, then you're going to want to find a really good syndicator or sponsor that you can put the money with and not be stressed about it, not worry about it, and start get those checks every month or quarter or whatever it is. If you're looking to build your own empire of real estate and own it yourself and do your own syndications, the key for you, being deployed, it's like any long distance real estate investing, is you're gonna want to find partners that are local to the area that you're in. So let's say you want to invest in Houston, right? You're going to want to find other investors who are investing in Houston, network, see if there's somebody that you can partner with. To go through the process that I just talked about for property management companies, start reaching out to brokers. All of that stuff can be done at a distance. You can do things like if you, obviously you're not able to tour a property, right? So let's say you're looking at a deal and the broker's like, well, hey, we're not going to take your offer seriously if you don't, if you haven't seen the property. Say, no problem. You get on BiggerPockets, you find someone in Houston, you say, hey, look, I'll pay you $50 if you can go tour this property, take pictures, take notes, maybe do some videos on your phone inside the unit and send that all to me, right? And now you've seen the property. So those are some of the things that I would do, that you can do while deployed to get started. And of course, you can read, research, learn markets, do all of that stuff as well. All right. Danielle, would you ever use direct mail for multifamily? How would you go about it? Yes and no. It depends on the size of the deal. So if you're talking about multifamily that's between 5 and I'm going to say 50 units, direct mail actually could be a pretty productive way of going about finding deals. The reason being is most stuff between 5 and 50 units tends to be kind of mom and pop owned. It's the doctor or the dentist or the local family that bought a 10 unit or 20 unit or 30 unit. And they're self-managing. A lot of times those smaller properties will be in the person's personal name, and so it's very clear who owns it and who you need to reach out to. And if I was doing that, I would do direct mail, but I would also try to just call the people, right? Use some of the skip tracing sites to try and find their phone numbers. And like White Pages, the paid version of White Pages. There's Fast People Search. There's quite a few of them out there now. Just Google itself, and sometimes it's in public records and recorded documents. And you can just reach out and call them. And candidly, I would say cold calling is probably going to be more effective than direct mail. But I would do both. And if I did not have the budget for a significant mailing campaign, then I would just go do the calling. Once you start getting from 50 to 100 units, direct mail becomes less effective because you're starting to get into bigger properties that are typically owned by LLCs. The true owners might be several layers deep and a lot harder to find. They're also probably going to be more sophisticated and less likely to just sell their property to you based off a letter that you sent them. And then once you get over 100 units, not to say you could never get a deal, but I would say direct mail is probably a waste of time. Anything, once you're over 100 units, generally speaking, you're talking institutional buyers, sophisticated sponsors, sophisticated syndicators, the decision maker. Even if you can figure out who owns it, you might have 10 or 15, 20, 100 people in an organization. You don't know who to get, reach out to or even get your contact to. And then also, generally speaking, the higher the level of sophistication, the less likely they are to make a decision like, oh, hey, I got this letter. Yeah, I think I'm going to sell my 200 units for, 15 million. Now, here you go. It exceedingly rarely happens that way. The best way, if you're looking for that bigger stuff, is broker relationships, because the brokers spend their lives building relationships with those owners, and they figured out who they actually are, and they can connect you. Cold calling and reaching out directly, that can work in the bigger stuff, but probably not direct mail. So great question. All right, let me see here. Ooh, lots of questions. I like this one. All right, what do you prioritize in value add, and how quickly do you see returns on those upgrades? When you're doing value add, whether it's a 10 unit or a 150 unit, the first thing to do is everything exterior that affects the look of the property and curb appeal, right? Because you can have the most beautiful upgraded interiors in the world, but if the outside looks ugly, nobody's gonna come in, right? And so the first thing we always do is curb appeal. So we do landscaping, we paint if necessary, we might upgrade pool furniture. Get some easy amenities, maybe like a dog park or throw in a playground. A lot of times we add shutters to windows, whatever we can do to spruce up the outside. New signage, maybe seal and stripe the parking lot. And we do that. And then we do that simultaneously while starting the interior upgrades. Interior upgrades, that's something that can take a year, 18 months, 2 years, depending on the size of your property. Another key area for value add, and candidly, this can be the easiest value add because we really like this because it also doesn't cost money, is management, right? A lot of properties are mismanaged, and if you can come in and do a better job managing, meaning better customer service, controlling expenses better, approving applications better. Some places it'll take 3 days for someone to get an answer. In today's world, no one wants to wait 3 days to find out if they can move into your apartment, right? You want 24-hour response. You want good maintenance service. You want to give people a fast and enjoyable customer experience. That is a value add. It's management play is what we call it. Another one is what we call loss to lease. And what that means, that's kind of a confusing term. Loss to lease is, let's say the market rent for a 2-bedroom is $1,000 a unit, right? And that's what's being advertised, and that's what, in October of 2019, you're leasing those units for $1,000 a month. But you just started doing that, and if you go back and look at the rent roll, all the other 2-bedroom units they're leasing for, let's say, $900 a month. So there's a loss there of $100, meaning the leases are, in a sense, losing $100 per lease compared to the market rate, right? So a big value add play there is just as those leases come up for renewal, you bump them up $100. You take them from $900 to $1,000. That's a value add. That is, and it's something that doesn't cost you anything. And can have a huge impact on the property. So those are some of the things we look for first, and that we jump right into. All right, Tu Fang. Hopefully, I'm pronouncing your name correctly. Do you open your funds to non-accredited investors? Also, would like to passively invest to get an experience. We actually do for now. There's generally speaking, there's two types of syndications: 506B, which means you can take non-accredited investors, and 506C, and which is only accredited. And this is something to keep in mind if you're going to start doing you're going to start doing your own syndications. If you're going to advertise or even mention returns to people in public settings, you need to do 506C, right? Which allows you to legally advertise, and you can only take accredited investors. To take non-accredited investors, which we do, is you do 506B. And the restriction is that you cannot advertise in any way. You can't go on a podcast and say, hey, I'm doing this deal, we're going to get these returns. You can't go to a meetup and stand in the front and say, hey, we're doing this awesome property, we're going to return 8%. You can't do any of that. But the upside is you can take sophisticated investors, and they do need to be somewhat sophisticated, meaning you should have an interview with them and say, hey, you're on BiggerPockets. Do you understand what multifamily is? What are your investing goals? Can you have this money tied up for 5 years or whatever it is? So if you're looking to raise money from non-accredited investors, that's the way to do it. And we all of our syndications so far have been 506B, and for the time being, I think we'll probably stay that way. And all right, yes, I pronounced the name correctly. Thank you very much. Give me a like and thumbs up for that one. Let's see here. Let's see. We've got top real estate books. The BiggerPockets books are amazing. David Green's long distance real estate investing one. It's focused on single family, but the principles still apply to multifamily, right? Long distance, and and then if you go back to kind of the granddaddy of multifamily education, Dave Lindahl. I actually just went back through his books this week, and they still hold up. It is Multifamily Millions and Emerging Markets. They are a little bit older, but all the principles, so it might not reference some of the latest technology, but all the principles are rock solid. So I would get those two books plus David Green's long distance investing, and get into and really read those, get deep. And there's a handful of other BiggerPockets ones that I definitely would recommend. Let's see, Narcissist. What determines down payment amount? What is the typical down payment? The short answer is the typical down payment is about 25%. What determines it will be the type of deal you're going after and the type of lender that you're using. So, for example, if you're buying a clean, stable 100-unit property and you're going after and you're getting Fannie Mae financing, they'll typically give you 75 to 80% of purchase price on that. And if you're doing some upgrades and renovations, they might even fund 75% of the rehab. So again, your down payment's gonna be probably 25%. In some cases, if it's a very clean deal in a good market, they'll give you 80%. So your down payment will be 20%. If you're looking at a property that's not stabilized, so maybe it's got 20% vacancy, got some deferred maintenance, maybe the market's not as good, then you could be looking at a 30% down payment, maybe even 35%. But just kind of a good rule of thumb, I would say, is 25%. So, all right, well, we'll take one more question, and then then you guys will see me back again sometime in the near future. Again, please remember, hit that like button, and show us that you love what we're doing, and hopefully we can do this again here soon. So let's see, what do we want to do for a last question? Let's see here. What exactly are you looking for to determine if an area is on the rise or decline? That's incredibly important. So we are looking for job growth. We are looking for population growth. And some of the ways you find that is the Bureau of Labor and Statistics. There's usadata.com. There is world population growth dot something com, I think. Uh, and there's a handful, and you candidly, you can just Google it. Pick a market. Say, I don't know, Tampa, Florida, and just Google Tampa, Florida population growth. Boom, and you'll find, all this. Generally, find all the stuff that you're looking for. Looking for job growth, population growth, income growth, job announcements, right? So you want to find out, what's being built, what's being added. How many companies are coming in, and then there's something called WARN, WARN, and it's reports of job closings. So if you go to like Tampa or Houston, there's going to be job closings and job openings and all kinds of stuff going on. But if you're looking at a small market and there's going to be a job loss of 400 jobs coming up in the near future, that could have a serious impact. So we check WARN to see if there's any significant job losses. But the biggest thing is job growth and population growth, and then after that, income growth. So, all right, I think we'll call it good for today and go ahead and wrap it up. Appreciate all you guys' questions. Thanks for hanging in there with us through the technical challenges. Again, please like and subscribe, and look forward to talking to you again in the very near future. Take care.